Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the market site in Times Square, we have Max Wasserman, Founder and Senior Portfolio Manager with Miramar Capital. We're going to take a look at de-risking portfolios in a highly inflationary environment. Max, it's great to have you with us. Welcome to Trade Talks.
Thank you so much.
All right, let's talk about the process that the market's in right now with the Fed adjusting its policy to try and tamper inflation, manage supply chain risks of geopolitics. Is the Fed really going to be able to do that just by raising rates?
I think what they're going to be able to do is control the monetary side of inflation, which is what they started. So they've been cutting interest rates really since 2008, and there's been a Fed put. So now what the Fed's dealing with is the monetary side of inflation. But the supply side chain, they're not going to be able to deal with. The monetary side they can by raising interest rates and start the tapering and really start to choke off this excess liquidity that's in the market. That they can do, but it's going to take some time. On the supply side, that's going to take a whole other issues. That's getting everybody working, that's dealing with COVID, China coming back in the market, it's the change in consumer behavior, it's energy prices. That part they really can't control. But they can control short-term interest rates. They can control all the excess liquidity that's led to this level of risk that you're seeing being de-risked right now.
So how are you advising your clients in terms of de-risking their portfolio? What should they be doing?
I think the first thing we look at is really they need to understand what is in their portfolio. Most people have been driven to higher risk assets because of zero interest rates. And they buy in things they truly don't understand. And they're investing in very leveraged assets. So by searching for yield and searching for return, they've taken on excess risk. So our first thing we tell clients is understand what you own and make sure you understand the volatility of the investments that you're in. For example, a lot of people have been buying into the S&P 500 with not really understanding that it's really a mini proxy for the Nasdaq 100. It's been all growth stocks. And so the beta, the more volatile it is than it's historically been because of that. The second thing we're telling our clients is if you're in leverage in any way, whether you're borrowing, investing, any type of margin, get off it. The third thing, in fixed income, is shorten your duration, shorten your maturity risk. As interest rates go up, it will hit the long-term bonds more, and look at your quality. So by doing those three things, you can lower the risk profile tremendously. And the fourth most important thing is, what do you want your investments to do? Are you swinging for the fences? Are you trying to hit home runs? Are you trying to create stable cash flow? Most clients have abandoned, in our opinion, reasonable behavior because of low interest rates. And they've gone searching for yield and return. And when the Fed takes the punch bowl away, you see what happens. The market comes down and people are stuck holding very risky assets at a third of their price.
Right. Well, okay, so the key question is, at what point do you think that we will capitulate? I mean, yes, we're oversold, but have we capitulated yet?
I think you could see another 5 to 7% down on the S&P. The S&P historically, as you know, trades around 15, 16 times. And we're still projecting a 10% earnings growth in 2023. We think it's a little bit too optimistic. So we could see the S&P pull back, but we think that's going to be more Nasdaq large cap tech stocks that are going to lead that pullback. So we think the majority of the market's probably in the 7th to 8th inning of the de-risking, but there's probably a little more to come. Now, emotions can take you to the extremes and you can always go, but we think we're pretty close to the end of this.
So what type of approach at Miramar are you taking in this environment?
Sure, we're refocusing on everything we continuously do, which is dividend growth stocks. We like lower beta, lower volatile stocks. We like yield, and we like companies that are growing it. So we're looking at companies that give us 3.5%. Our dividend portfolio averages about 3.2%. Trades roughly around 14, 15 times an aggregate level, and it's growing its dividends at 8 to 10%. So we're looking for those type of things that can weather the storm. So we want short term, we want cash flow coming in to reinvest at a higher interest rate. The second thing we're doing is we've shortened our duration on the bond portfolio. We've lowered our risks, right? But we've been doing this for the past year. To do it now, it's sort of late. Right. So we have been telling our clients since last year that we've been taking profits in our Nasdaq-oriented stocks. We've been de-risking even a little bit more. But right now, to tell the clients, you're 70% through it. So you're just really trying to protect the last few dollars. But we've already taken steps, so we're building dividend growth portfolios. We have been since our foundation.
Right. Any specific sectors that are more attractive than others?
Well, there's sectors that we like, but we're more stock specific.
Right.
So, but we do like the industrials. We do like some of the consumer cyclicals. There are some energy stocks we like, and we do like selective technology that we do like.
All right, Max, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.